Good afternoon, everyone, and thank you so much for having me today. I'm Holli Heiles Pandol. I'm the Senior Counsel and Head of Policy here at Carta. And today we're going to walk through one of the most powerful and maybe most underutilized tax incentives available to small business owners, their employees, and their investors, Qualified Small Business Stock, or QSBS. Let me share my screen really quickly. All right, can we see everything? Going to assume that's a yes. So moving along, as I mentioned, I'm Holli Heiles Pandol. I've been at Carta now for about 5 years, but I've spent my entire career in financial services policy and tax policy. Prior to coming to Carta, I was at the Securities and Exchange Commission, where I led the Office of Intergovernmental and Legislative Affairs under former Chairman Jay Clayton, and spent about 6 years on Capitol Hill before that, both working for the Financial Services Committee and an individual member on economic policy issues. But at Carta, where the policy team sits, is really at the intersection of policy and private markets, which means we try to serve as the connective tissue between Congress, the regulators, and the innovation ecosystem, translating, what's going on in Washington into practical guidance that you can use and navigate. And QSBS fits squarely in that lane. And just a housekeeping item before we get started. This is not going to be legal or tax advice. QSBS eligibility is very much a fact-specific, determined security by security, taxpayer by taxpayer. So to the extent you have questions, I would definitely recommend reaching out to your tax or legal advisor. But our goal today really is to give you enough background to have an informed conversation with those advisors and know the right types of questions to ask. So what are we here to really talk about? When you look at QSBS, if you sell QSBS eligible shares, what that means is you could potentially have zero tax liability on up to $15 million in gains. This isn't a deferral. This is excluded, zero. You pocket all the money and pay no tax. So it's a pretty big deal. I was actually shocked to learn we have a QSBS attestation product here at Carta, but I was shocked to learn that 95% of the people who ended up purchasing this product actually weren't even aware of the QSBS benefit before, talking to our folks at Carta, which likely meant their employees probably were not aware of it either and may not have had the opportunity to properly plan to take advantage of QSBS. So to that end, we've started doing a lot more education and advocacy events like this for small businesses and their employees who may not have thought through QSBS and could potentially be leaving serious money on the table. So just a quick backgrounder on Carta. So for those of you who may not be familiar, we essentially provide the operating infrastructure for private markets. On the company side, we provide cap table, equity management, valuations, and tax services for over 50,000 privately held companies, as well as fund administration, investor reporting, compliance for their investors. So SPVs, venture capital funds, private equity, private credit. You can think of us as the ERP, or the system of record for the private capital ecosystem. And then just to give you a sense of kind of our footprint, I mentioned we had over 50,000 companies, over 4 trillion in equity on the platform, and about 9,000 fund vehicles. But what I get excited about and get up every day for is policy. And just wanted to touch quickly on why Carta even has a policy team, because it is a unique function for a company like Carta, but it's also unique in the way we approach it. So given our footprint across the private capital ecosystem, we're not out there advocating just for things to benefit Carta. It really is, how do we help bolster and broaden the entire ecosystem? So we think about that through three main lenses. One, obviously, is the policy. How do we advocate for policy to lower barriers, expand private markets, and support the innovation economy? The second bucket is profile. So we take what we're learning in DC back to the ecosystem through events, blog posts, other information that we put out, and try to help the ecosystem understand and navigate what has so often been an evolving policy landscape. And then finally, on our product side, to the extent there is a regulatory change, we work with our team to help shape products that either meet a compliance need or, help you take advantage of a certain policy initiative. And there's no better example of this than QSBS, which is something I'm incredibly proud of. When we were going through, or when Congress was going through the tax reform debate last year, we were actually very concerned that QSBS could potentially be on the chopping block or that it may be significantly curtailed. We had seen efforts a couple years earlier to do that, largely because they could use this as a way to help pay for or offset some of the, cost of extending the other tax benefits that were set to expire. So Carta led the charge. We pulled together a broad coalition of innovation-focused organizations. We actually formalized the Innovator Alliance to go up to the Hill to educate policymakers and, one, make them understand why QSBS is so critical and it needed to be protected, but also made the case for why it should be expanded. And we were very successful. We were able to, again, not only maintain the QSBS treatment, but we were able to expand the gross asset threshold, allowing more companies to benefit from QSBS. We increased the cap on individual gains that could be excluded from QSBS by $5 million. And now, instead of having to wait the full 5 years before you could sell your QSBS eligible shares, there's a phased in period allowing shareholders to take advantage as early as year 3. And some of this is repetitive, so I'm going to apologize in advance, but just to bring home the point, why this matters so much for business owners. Again, it's 100% capital gain exclusion on the sale of QSBS eligible shares. That's money that you can take and reinvest, put to the business. And, when you think about 20% on $15 million, that's real money. And then with the expansion, having more businesses available or eligible to take advantage of the benefit can make it even more valuable. So jumping into QSBS basics. So qualified small business stock is a stock in a domestic C corporation that meets specific requirements under Section 1202 of the tax code. So if you're a shareholder and you sell qualifying business stock after the required holding period, you can exclude up to 100% of the capital gains from federal income tax. Now, I think it's important to talk about why QSBS was enacted in the first place. And, even though we recently got an expansion, this isn't new. It goes back to 1993. It's been a bipartisan, it's had bipartisan support in Congress, and it's actually been expanded a couple of times. But the whole point of this is to encourage investment in small businesses by rewarding entrepreneurs, early employees, and investors who are willing to take the risk to build and fund a new company. Startups are riskier by nature, and having this QSBS benefit makes it more appealing for investors, founders, employees who may choose to go work at another company or a public company that provides a little more stability. It incentivizes participation in the startups, which are so critical to innovation in this country. And the one thing I'd love to point out, and one of the points that we really tried to hammer home when we were talking to Congress about this last year, is this had, in recent years been painted as a billionaire tax break, something that's only for the wealthy, but this is something that benefits across the board. Again, it benefits those founders, the entrepreneurs that are willing to take a risk, but it's also for those early stage employees. And actually, when we looked at the data, Carta has, again, with our footprint, a lot of data. Employees were overwhelmingly the benefit of all of the QSBS expansion efforts. So I touched on this a bit earlier, but just to kind of put in perspective the changes that the One Big Beautiful Bill Act, or the tax reform bill from last year, made was the increase in the gross asset cap. But it's important to keep in mind, so any shares that were issued before July 4th of last year are still going to be subject to the old rules. So the 50 million in, the gross asset cap. The 75 is only going to apply for shares issued after the law was passed on July 4th of last year. And same goes for the taxpayer exclusion and the holding period. And the important thing to note there is it is tied to the actual share issuance. So you could have a situation where you had shares issued before under one set of rules and shares issued after and under another set of rules, but just wanted to flag that to keep that the timepiece in mind there. So digging into the requirements, there's two sides to QSBS eligibility, on the company side and then on the shareholder side. So for the company has to be a domestic C corporation. So it can't be an LLC, it can't be an S corp, although there are efforts to try to expand it to S corps now. Again, the gross assets less than or equal to 75 million at and before issuance, 50 million prior to July 4th of last year. And then this is an important one, 80% of the assets have to be in an active qualified trade or business. And that has to be maintained substantially throughout the period of the QSBS holding period. Basically, most of your service businesses are not going to be QSBS eligible, but it's important to think about, it's not necessarily the label, it's what the business, looking at the business mechanics to make that determination. On the shareholder side, the biggest piece here is that it can't be a non-corporate taxpayer. So in other words, it has to be an individual, a trust, or an estate. The stock also has to be acquired at the original issuance, so directly from the company. It can't be, you can't go out on the secondary market and purchase shares and still have it qualify for QSBS, although there are a couple of exceptions that we'll talk about in a moment. And then we already discussed the holding period, so I won't belabor that point. But just a kind of deeper dive on the types of businesses that qualify. So again, if you're looking at tech and software businesses, manufacturing, construction, engineering, any kind of e-commerce or retail, biotech and life sciences, those are going to be the types of businesses that generally qualify for QSBS. And again, your services businesses, your hotels, restaurants, any of your kind of like professional services, accounting, law, financial services, and healthcare probably are not going to meet that qualification. But again, a lot of this is facts and circumstances. There aren't cut and dry rules out from the Internal Revenue Code as to, where those bright lines are. A lot of this is done through private letter rulings, or these kind of like one-off bespoke guidance issuances. So this is where it could be helpful if you're unsure or on the line to talk to a professional about that. So now let's talk a little bit about why QSBS tax strategy is so important and how this can support companies' long-term growth. So first of all, again, if you do the math, if you exclude 100%, if you have 100% of QSBS excluded on a $15 million gain, that's over $3.5 million in federal tax alone. And we'll talk about this in a moment, but most states also have a corresponding QSBS benefit as well. Another important piece to think about is there's something called a Section 1045 rollover. So I mentioned you have to hold QSBS, for that 5-year period if you want 100%, and then there's the phased-in periods now at 50 and 75% for 3 and 4 years respectively. But if you were to sell your QSBS eligible shares before one of those time periods, but then immediately reinvest that into new QSBS eligible stock within 60 days, you could still have that QSBS qualify. So that's an important thing to think about, particularly on the investor side as they're, evaluating opportunities and the potential for QSBS. Another important point to keep in mind, especially as you're setting up your business, is, whether or not you think you may want to pursue QSBS or be QSBS eligible. That may determine the type of entity you structure as. So I mentioned you have to be a C Corp. So you may want to start as a C Corp out of the gate. Or, if you are an LLC or an S Corp, think about incorporating or reincorporating as a C Corp, because you can make that transition. But the important thing to note is, if you're issuing, it's the 5-year time period, for example, is going to start at the time of conversion because it's tied to the C Corp stock. So even if your business has been, operating, let's say for 6 years, but you don't make the conversion until year 3, the conversion date, the third year is when you would actually start that QSBS timeline to be able to take advantage of the benefit. And then finally, something that I know our CEO in particular has been, he's been shouting from the rooftops, because again, we've done a lot of these QSBS type webinars, is how you can use QSBS stacking. So this is basically, I mentioned you had to acquire the stock directly from the company generally to be eligible for this. This doesn't count if it's a gift or a bequest or an inheritance. So if it's coming from a family member in one of those situations, it still maintains that QSBS eligibility so long as the way it was originally acquired by, your relative, it would meet the qualifications. So, again, if you want to kind of maximize that, per taxpayer exclusion, because this 15 million, it's not tied to the stock, it's tied to the taxpayer. You could potentially, gift shares to trust for the benefit of your children. If you're, your spouse, you and your spouse could each claim the 15 million, particularly if, it's a company that, you're very proud of, it did very well, and you see some exponential growth. So there are ways to kind of maximize those benefits across the family unit. But again, this is where planning is so important, and being able to set that up early, because it's much harder to kind of go backwards and, plan for, or, prove QSBS, or kind of like reinvent this process. And it's also a lot more expensive. So one, the things that I do want to highlight is why it is so important to kind of document this and maintain that documentation if you are pursuing QSBS over the life, because you may save yourself a lot of headaches in the end. And then actually didn't have this on the slide, but 2 things to think about too, just from a strategic move is, not thinking of QSBS simply as a tax break, but how can you leverage this as a strategic tool to help, your business compete and grow? So one is by attracting investors. Again, you have the pieces in place to show that you're tracking QSBS, you've got this top of mind, so you're, hopefully not going to run afoul any of the traps or the common situations that we see go wrong, which I'll mention in just a moment. But you can do this through something called QSBS attestation. where, you'll go to an accountant, someone like Carta, again, because Carta tracks those securities, we can kind of like maintain that across the life of that equity holding, to say, at the time of issuance, this was QSBS, and now on a yearly basis, like I've maintained this QSBS. So if you're trying to get more people to invest in your company, that may be something that they are looking for, and they'll appreciate a professional and organized founder who has that documentation ready. And even like for those of you who may receive venture capital funding, these are starting to be built into a lot more of the LPAs now as well, as a requirement for investment, is maintaining that kind of QSBS treatment. Another thing to think about is, again, this is a huge benefit from employees. So if you're trying to get, the best engineer to come work at your startup, where they may have, offers from some of the other big tech firms, or these, AI companies that are just like going through the roof now, this is a potential to say, hey, if you come and we build, you could potentially exclude all of this potential gain from taxes. So again, it's just like another way to kind of incentivize, hire, and retain talent. So we talked about all the benefits and the requirements of QSBS, but now let's talk about some of the common mistakes and what you need to avoid to ensure you don't trip up your eligibility. Because again, you do have to meet every prong, and we see this like all too much, where someone thinks they have QSBS, but something happened and it ended up not being so. And again, that's a significant amount of money. So the first one that I'll mention is, again, just having the wrong entity type. Again, only available to C corporations. So I mentioned that the time period actually doesn't start until, if you are not a C corp and you incorporate, or you reincorporate as a C corp, the holding period is not going to start until that C corp conversion. So that is one area that we see where founders may run afoul of the rules. So again, it's just something to keep in mind as you're deciding to start a business. And there are a host of other tax reasons for why you may choose a different pathway, but again, for QSBS, it's just something to keep in mind. Another area where we see companies run afoul of the rules is they raise too much capital, or they do something to push them ahead of that gross asset limit. And this is why that $25 million step up from $50 million was so important, and how this is really going to help expand that benefit, because this is something we saw in particular with, maybe there's an acquisition, a new fundraising round, there's some type of licensing agreement, or, even just like inventory could cause a company to potentially exceed this threshold and lead to issues where you may or may not be eligible for QSBS anymore. I mentioned the 80% active business test. So again, you still have to be involved in a business that would qualify for QSBS, but you have to think about, how much cash are you holding? How many, passive investments do you have? Is there some aspect of the business that may not meet the qualified business test for QSBS? And does that trip the 80%? So again, under 1202 of the Internal Revenue Code, you must satisfy the active business requirement for substantially all of that holding period. Excuse me. So if a company were to fail one of these tests, the stock may lose its status. And then, we talked about, it has to be required directly from the company. So any purchases on the secondary market are not going to qualify. This is something where we see investors often get confused about how the stock is acquired, and they may think their investment is QSBS eligible, and it's not. But another part where we see this is around share repurchases. So again, if the company, were to buy back its shares and it exceeds a certain threshold, a 5% threshold, shares issued 1 year prior and 1 year after the buyback may be disqualified. And, I will continue to hit on this, like the poor record keeping, if you're keeping track and keeping your documentation current as to like when the stock is issued, whether or not it was QSBS at the time of issuance, that can help make sure that you're not, kind of tripping into or like falling into some of these common mistakes. And I actually have a couple real world examples at the end where, Carta through our product, have caught a couple of things for companies and in some instances have been able to prevent them from tripping this up. And I do see questions in the chat, and I'm going to do one more slide and then I'll pause and get to some of those really quickly. So state level considerations, I mentioned 1202 is a federal tax benefit. So for the most part, states follow the federal tax law and will offer a corresponding QSBS benefit. The big caveat here is California. California, if you're a California resident, you could have 100% federal exclusion, but you're still going to pay California capital gains tax on that bill. But we have seen in recent years, like New Jersey is a great example. Last year, adopted the federal QSBS standard. There has been a bigger push to kind of unify those pieces. So, sorry, I'm just navigating a couple of screens here. Before we get into kind of best practices and some of the resources that we have out there, I'll go through a couple of the questions in the chat. One, how do employees benefit from this? So when you think about if you're a private company employee, you're generally going to be issued options or stock as part of your compensation. That's a lot more common these days, particularly in the tech space. So again, if your company is QSBS eligible, and actually our product we generally sell to the companies, so the company can say we're QSBS eligible, so these shares that you're receiving at the time are also going to be QSBS eligible as well, so long as you hold them for that requisite time period. And then again, it's on the company to maintain the other aspects to make sure that those shares that remain eligible. But the important thing to keep in mind for employees, and this is like where actually Carta really stepped up because we had a liquidity round a couple of years ago and realized how many of our own employees were not aware of QSBS and had some issues with eligibility, because if you have options and those options aren't exercised before the company or at the time it was the $50 million gross asset threshold, that would then make those options not eligible because the shares actually have to be exercised. So again, it's the same, as long as the stock is QSBS eligible, the employee would get the same benefit as the founder, as the investor would be able to exclude that from the tax. But the important thing to think about there is on the option side. I see a question on how QSBS acquired through safes will be treated. This is actually an area where we are working on legislation to make sure that it is clear that the safe is treated as, from issuance, that when the safe converts, it would be treated to the date that the safe was issued. That I would say that's probably the general consensus in the industry, though it's one of those gray areas that's not particularly clear, and the IRS hasn't provided specific feedback to that end. Although this is another thing where we may get some clarity coming down from the IRS. But again, I think talk to a tax professional, can't provide tax advice. But the general sense is that safes are treated just like options or anything else would be at the time of issuance. So on I got a question, what is the range of the requisite holding period? So if you look at any shares that were issued before July 4th of last year, you're going to have to hold those shares for 5 years. But at the end of the 5-year time period, you'd get 100% of that gain excluded. For any shares issued after July 4th, it starts a sliding scale. So if you hold for 3 years, you're able to exclude 50% of that gain. If you hold for 4, you can exclude 75% of the gain. And then again, if you hold for the entire 5, as was the case before tax reform last year, you'll get the full 100% of the gain withheld. And this it allows you to take advantage of it sooner because, especially, there's a lot of liquidity needs, a lot of capital needs for particularly younger employees who may want to buy a house or something and, kind of be stuck with that, 5-year time period when you happen to have a liquidity event. This enables employees to make this a little more meaningful earlier on. Oh, okay. Jumping back in. So again, a couple QSBS best practices. I've talked a lot about this throughout the presentation, but again, making sure you're continuously reviewing QSBS eligibility. Again, there's a lot of potential traps that you could fall into, but having that kind of annual check, particularly as your company is growing and raising capital, is a good way to kind of stay on top of that. And then, whether it's for your investors or kind of for your own defense, having some kind of attestation from a third party to say, the stock was QSBS eligible at the time of issuance, the date of the issuance, so you can kind of like build in that time period and basically just like have a record. Again, if there was ever an event that the IRS may challenge you for claiming the QSBS exclusion. I said this is something that investors may already be requiring per your agreements. So having that kind of like formal attestation letter is something good to share with investors. And then finally, again, there's a lot of misconceptions for people who have heard of it, or just a lot of like people just don't even know that the benefit exists. So we've done a lot of employee education on equity in general, but particularly on QSBS. So the more you can do to educate your employees on the benefits, and again, not potentially tripping up an option grant or something like that to ensure they can take advantage of that as well. And then I will do a quick plug for some of our resources. So Carta has a ton of resources for every stage of company, for investors, everything from, the fundraising process to compliance. But we built out a huge collection of tax and QSBS employee equity resources. So everything from, basic definitions, how founders should think about a QSBS strategy, to, a potential QSBS calculator. We provide a lot of this on our website for free. And at the end of this presentation, which we'll also share, we'll have the link so you can access all of that. And I do see a question about QSBS attestation for its customers. Yes, we do have a QSBS attestation product. We, again, generally offer this to the companies, and then the companies can share this with the investors or the employees. But basically, the way our attestation product works is, if you're a customer of Carta, we're going to have your cap table information. We'll see, all of your various equity rounds and have that visibility. So we can identify, securities that may be QSBS eligible for all of the shareholders on your cap table and confirm that your company is eligible for QSBS treatment. We can issue letters for both the company and the shareholders, those QSBS attestation letters. And then to the extent, there are questions around eligibility or potential strategies, we do have an equity advisory service with professionals to kind of provide advice and counsel through that. And then just a couple of points to close on. I like to share these because these are actual, I got these from our QSBS team as to a couple of scenarios where, some it didn't work out, but where we were actually able to prevent a company from tripping up QSBS eligibility. One is on the cash management side. So there was a company that had, built up inventory. We had, they'd engaged us for QSBS attestation. And, as we're monitoring, we can see this happening, and, we're able to advise the customer that they were kind of running up against that threshold. And they were able to pay down under the $50 million limit to be able to take advantage of QSBS status. So again, that's something, particularly as the company is raising rounds or getting close to that limit, that's something that we can monitor there. And then the other one I'd point out is on the share repurchase. And again, this is, think people will understand the primary issuance, but don't think about the share repurchase. So if the company is reissuing shares, that it is purchased from senior management in particular, that could potentially run afoul the QSBS treatment. So that was an event that we ran into not too long ago because the company repurchase exceeded the amount that was eligible for QSBS. It ended up blowing the eligibility of those shares. That is something we were not involved in on the front end, but we found that when they came to us for a QSBS attestation. And then again, wanted to provide links to our resources. So we have the QSBS equity management, and then just on like policy more general, we tend to focus on, I would call them infrastructure issues. So that's everything from tax to capital markets policy. So when you think about like the fundraising environment and how that's regulated, and increasingly, as AI and tokenization and all of these other innovations are rapidly coming to market, we're keeping a close eye on those developments as well. So we do a weekly newsletter that is very curated to this audience. So it's not like the traditional like DC newsletter. So I'd encourage you to take a look at that if you're interested. And then we have a policy desk as well, where we not only publish our weekly newsletters, but also like blog content and other events. And that's all I have. If there's any questions I missed, or if anyone else has questions. Okay, so yeah, I had another question that I'll be addressed. And apologies, it's trying to drive slides and watch the chat, so give me one moment. Okay, so I think it's this question. It's the shares of a small technology development business, which is a C Corp, is acquired from that company when they converted to S Corp and held the stocks. Then the company went back to C Corp. Will those stocks be treated as QSBS if the holding period and gross asset values requirements are met? I would have to double check that. I would assume the conversion to an S Corp that may trip up that holding period. Now, if it converted back to a C Corp, if I'm understanding the question correctly, I would think that it's probably from that latter date, but I would have to go back and double check that. And again, can't provide tax advice, but I think the whole point is you want that consistent the hold period as a qualifying company, which is a C corporation. And my contact information is here. And, again, through our equity management, that web link that I put on the end of the slides, I'm happy to connect with our team who is a lot more knowledgeable about this issue than I am. They do this literally, this is their day job. So happy to make those connections. And yeah, if there's any follow-up, please don't hesitate to reach out. Thank you, everyone, for the time.